Hi, I'm Troy Sharpe, CEO of Oak Harvest Financial Group and Certified Financial Planner Professional. Today we're going to interview Chris Perras, and Chris is going to share his insights into what's going on in the market today with the goal of helping you become a better investor. Chris finished his electrical engineering degree from Georgia Tech, went on to Harvard Business School, and then he went on to manage the #1 mutual fund in the country, the #2 fund over both 3 and 5 year periods, and one of the things he's most proud of is his work at AIM, turning their flagship fund, the Constellation Fund, around from $12 billion to $30 billion. So Chris is going to share his insights, his experience with you to help you become a better investor. Before we get into some insights to help you become a better investor, I want you to get to know Chris a little bit and go through his career and background and what that looked like from his perspective. So Chris, you finish your undergrad at Georgia Tech, engineering, but then you decide to go to Harvard. You get in, obviously, and the job search begins once you graduate. What does that look like? Where did you end up? And tell us a little bit about that experience.
Yeah, so I knew going back to Harvard that I wanted to get into public equity money management. So as it neared graduation, I interviewed with probably the 10 to 15 companies out there that were interviewing, had a couple opportunities at some bigger shops, but eventually settled on a smaller manager in the Boston area.
So how many people in your class wanted to manage money? I imagine that would be a pretty common thing over there?
It wasn't at the time. There was 8 to 10 of us. We were kind of the outcasts at Harvard. Everyone wanted to go into consulting and go work for McKinsey or Booz Allen or something like that. And there was a handful of us that wanted to manage other people's money.
So you know what you want to do, and where do you land your first job?
It was a place called Hellman Jordan in Boston.
Okay. And then from Hellman Jordan, you went to?
I came down here to Houston as kind of a promotion to work for a shop here in town called Van Kampen that was eventually merged on with AIM Invesco. But I've been a generalist my entire career. Worked in a number of different areas, a number of different companies, managed small cap money, managed large cap money, managed money very confined to almost indexes. You know, looking at the S&P 500, I have a unique background because most people, when they manage money, when they go into the business, they learn one way and they're taught one way. I've worked at a number of shops. You can look at my bio online. People say, hey, you moved around every 3 years. I did, but it was for new opportunities, more job responsibility, or to learn a new way to invest.
So one of the things that stands out obviously on your bio was managing the #1 fund in the country. Where did you do that? And tell me a little bit about the investment methodology that you used there and how that helped to shape your career, or at least the way you look at markets and some of the insights that you glean that we talk about all the time here, but you also applied to your job today.
Right. So at Van Kampen, we ran a very aggressive growth model. It was kind of an incubator at the time. It was novel. Right now, you would probably compare it to one of the ARK investment funds. You know, the fastest growing companies out there that you can invest in did that, you know, as well as managing another fund that was more indexed to the S&P 500 large cap growth.
More top-down analysis back then, or was it more fundamental valuation of cash flows, earnings, et cetera? What was the methodology and the style that you really focused on?
That back then it was more top-down in that we were looking at revenue growth first and foremost. You know, these companies that are growing really fast don't have a lot of margin, don't have a lot of profitability, so you're looking for big opportunities, growing markets. In that product we were.
So one of the things when you have companies that have very, very large revenue growth, these startups, these kind of incubator type companies, when you think of Cathie Wood's, ARK funds, they don't have a lot of profit, like you said, but the investors' anticipation is because of the significant revenue growth, and we're talking, what, 50%, 100%, sometimes, right. I imagine in the thousands of percent in the initial stages. Right. Investors believe down the road that revenue growth will ultimately lead to profits. One company comes to mind immediately is Amazon. So for years and years and years, Amazon just kept reinvesting, and analysts were wondering, okay, are they ever going to have a profit? And I guess that's probably one of the greatest growth stories of all time as far as the reach that Amazon has today. But it wasn't always seen that Amazon would ever get to the point where it is now.
No, it wasn't. One of my past histories was I actually had the opportunity to meet with Jeff Bezos 1 on 3. I think there were 4 people in the room during the IPO roadshow. And I was sitting right across the table from him. And at the time, they were selling DVDs and books, and that's about it. And he basically said, I called it Amazon because I want to sell everything. And, it was 1997, 98, and you're thinking, sell everything? I'm never going to buy a TV online or paper towels. And he understood that the internet was a distribution method. And I myself didn't get it at the time, but he was like, I want to be the Dell of everything on the internet. And Dell's greatest invention, Michael Dell, right over in Austin, his greatest invention was shrinking the lead times for building a PC. So you would write him a check up front, and then he might take a month or 3 months to get you a PC. And so anytime you have a business model like that where people are giving you cash up front, and then you give them a product down the line, it's massively cash flow positive, and you can do wonderful things. And Amazon, it's the history of that company. I missed it for a number of years.
So you're managing small cap, aggressive growth type companies with that first position, does really, really well. From there, at a younger age, how are you feeling? Does the ego kind of creep in at that point, or?
No, I don't think I have that big of an ego. I worry about everything. That's why I tell people, when you go in and see your RIA, when you meet people, if the person has a full set of hair, they're probably not managing the money because they're not worrying enough. And I've come over to the RIA business now, I guess for about 5 or 6 years, and Oak Harvest for 3 great years now. And people ask me, what's the difference between institutional and individual? And I said, for me, there's not much difference. I still worry about the same things. When you're managing institutional money, you're worried about, am I beating the S&P 500 by, 1% or whatever the number is. When you're managing individuals' money that you sit across the table from, I worry about everything. I worry about, what are taxes are going to do? What's COVID going to do? What's the headline coming across CNBC going to do? Because our clients are watching the news. They're watching CNBC. They're watching Fox News. And I know that their worries are my worries, right? And I try to worry about those things actually months before they already are. What's their next worry?
And one of the things you do a great job with is the Stock Talk podcast. So every Friday we send out the Stock Talk podcast. We have them on the website. So the Stock Talk podcast you do a great job with. Really, really appreciative, not just me and everyone here, but obviously our clients. So you move on from Van Kampen, and what's the next step in your career?
I went out to Silicon Valley to manage money for a fellow named Garrett Van Wagner during the internet boom. And it was crazy, right? 1997 through 2000, 98 through 2000, we were managing almost all technology money. The markets went straight up for technology, straight down, and then straight back up. And after about 2.5 years of that, I was asked and recruited by a friend of mine who was working at AIM to help come back to AIM and work with him and for him and help turn around Constellation.
What did you learn working out at Silicon Valley, focusing on tech companies, going through the bubble, seeing the bubble crash? What did you learn, and what can you share from that experience with the viewers and listeners today?
I learned that I'm not a 100% technology investor because my goals and objectives aren't to try to grow my money 60% a year every year, and I hate waking up and seeing a stock down 20% or 30% with no control. Learned that, and learned a lot about how people value those companies with regards to market opportunity. Is it a $20 billion market or a $500 billion market? And how many years can they grow at 50% or 60%?
A lot of times we'll see clients that have a significant concentration in Apple, Amazon, Google, Facebook, Microsoft, the big technology stocks. And I believe there's a sense of almost peace with a lot of people because these companies are so big and their products are everywhere. And What would you say to those people from your experience, even though these companies are big, especially if you're approaching retirement or in retirement, there obviously is a false sense of security just because those products and those name brands are so recognizable and everywhere. But what would you say to someone who maybe has an overly aggressive concentration into Apple, Amazon, Facebook, etc.? What would you say?
Yeah, we like to diversify, right? And those companies, I think, now account for about 25% of the S&P 500. If you're up in 50% plus technology, probably as a retiree, you're probably a little aggressive, at least for most people's portfolio, unless you're looking at just handing that money over to your grandchildren, and they're going to not look at it for another 30 years or 40 years.
So you're not depending on that money at all for income,
correct,
for funding any of your retirement goals. And obviously, the basic principles of a diversification can help reduce risk in any portfolio. What we see today as far as the technology sector leading the S&P 500 in growth over the past 10, 12 years, decade plus, not the same as the internet bubble that you went through. And but obviously having too much concentration for anyone can lead to some pretty disastrous results.
Right. I mean, if you have those companies and you've owned them for 10 years, you've made great decisions, right? And the question is where do they go from now? And what do you need to do with the money? We have a lot of clients who grew up and made their careers in the energy industry, right? They looked at their portfolios and I know everything there is to know about oil and gas, but the stocks don't really care about how much you know about that industry. They go through cycles too. Technology will go through cycles. When interest rates start moving up, these technology companies, their discounted cash flows will be valued at a lower level. They're not, they may not crash, they may not, flame out, but the valuation that they get for each incremental dollar in cash will go down.
And ultimately, too, once you have $1 trillion market cap or approaching a $2 trillion market cap, investors are valuing a company's stock. One of the things they are looking at is margin expansion, which is dependent upon either cutting expenses or revenue growing. Mm-hmm. And these companies, great companies, but the next 10 years, it's probably very likely that they won't have the same revenue growth or profit growth. Now, anything's possible, of course, but probably not quite the same explosive growth over the next decade as we've seen over the last.
Right. I mean, if you look back at the leading stocks, in the 70s and 80s, they're not the leading stocks now. Procter & Gamble isn't one of the largest market cap companies. GE is almost nowhere on the top 50 list of companies, except maybe if you work for the company. But its stock performance, it's nowhere to be found. So the leadership changes, some new secular dynamics will show up, and some of these companies will stay the leaders, and some of them will slow down and fall by the wayside and be new companies.
So at that point, did you go back to AIM?
At that point, I was recruited back here to Houston to help work on AIM Constellation, which at the time, great tool for people, but it had been lingering at probably 12 billion. The performance had been mediocre, kind of a large cap GARPy portfolio. At the time, I think when I came back, it had 600 to 750 names across 11.5 billion, and we culled it and got rid of a lot of stocks and tried to concentrate it more.
So GARPy, what is GARPy?
Growth at a reasonable price.
Okay.
So you kind of look at the revenue and their earnings. Is it growing at 20%? I may be willing to pay 25 times. So you kind of look at how fast it's growing versus the multiple.
It's funny you say that, because I recently going through a client's portfolio, and they, of course, like a lot of times we see, had 20, 30 mutual funds, a lot of overlap. I believe one of them was called the Growth at Reasonable Price Fund. Do you remember this? Did I show it to you? Yeah. So, okay, growth at reasonable price. Essentially, they're looking at value, modest growth, aggressive growth, and what did you bring from your experiences in those years prior to that fund? Because turning it around in 3 years from about 11 or 12 billion up to 30 billion, obviously you experienced good growth, but the fund had tremendous amounts of inflows when I imagine when you got there was having outflows or at least lingering, like you said?
It was relatively, stable, lingering. We concentrated the portfolio more. You can't have 700 great ideas, right? You probably can't even have 150 great ideas, but we just concentrated it more into our top ideas into the companies. Instead of owning the top 10 companies in the industry, we narrowed it down to the top 2 or 3. With that much money, we weren't going to run 10 to 20 names. Some people run those kind of concentrations. That's not what we were doing. Because we also wanted to own some smaller positions in companies that could be maybe the next Amazon or the next Microsoft. And so we wanted some smaller positions that could grow at faster rates.
So small cap company focused on revenue growth. Then you go to Silicon Valley focused on technology. You come back to AIM, and I take it this is a large cap fund, correct?
Yes.
Mostly a large cap fund. So now you have 3 different exposures essentially, which is starting to form your investment philosophy and your career.
The AIM Constellation Fund was probably the broadest, largest basket of assets I've ever managed. And so to outperform or keep performance good, we weren't going to just run totally to one side of the ship, right? That's just too much risk for our shareholders.
The ice tray would flip over.
Yeah, you just dump all the water out, or you just have one big ice cube and only one person could eat it.
Only one bourbon.
Yeah. So we would tilt things. So, when we saw the economy picking up, we would buy more cyclical stocks, more technology stocks, and more banking stocks, financial stocks that get a tailwind more than something like a utility stock or a stable stock. So we would tilt it from a macro standpoint, depending on where we were in the economic cycle.
From a macro standpoint, based on, let's say, the winds of the economy and how things are shaping up, that's, I take it, what you guys did and helped to turn that fund around from 11 to 30 billion, 12 to 30 billion?
Yeah, it was a growth fund, so we would disregard a lot of sectors that we thought weren't going to grow much and not provide the outcome that our shareholders wanted. So, yeah.
And this is one of the things, we analyze thousands of portfolios every single year for prospective clients that are coming aboard. And one of the common mistakes that investors are making, especially when they're managing their own money, is not being able to connect those dots to what's going on with monetary policy, with economic policy. For example, if the Federal Reserve is continuing to stimulate the economy through printing money and supporting the system, if interest rates are going up or if interest rates are going down, all of these things contribute to which sectors of the economy are going to perform better. And we see all the time this disconnect between the average investor and their understanding of what industries they want to be in. And we'll see overconcentration into industries, especially here in Houston, the oil and gas industry, where the economic winds are blowing way over here, but they really like these companies. So we have 7 different entities or publicly traded companies in the portfolio. Anything you can share with the listeners or viewers as far as, now obviously look, everyone here isn't going to go to Harvard. They're not going to manage institutional money to the level that you've done it before with your accomplishments. It's a career of learning that you've established. But what can we share with people to help them maybe understand aligning their portfolio and the companies they're invested in regards to the economic conditions?
Just because you like a company and you're familiar with a company doesn't necessarily mean that it's a place to put your money relative to everything else in the market. And the default in the stock market is, I want to be in the stock market, I don't know what to buy, I'm going to buy everything, which is the S&P 500. It's cheap, and you don't have to make a lot of decisions. But when we construct a portfolio for retirees, we're trying to balance some income and some growth. And our goal isn't to it's not to beat the S&P 500 every month or every quarter. It's to create a portfolio that can grow, provide some income if they want that, and to balance risk and return. And then, we shift it around when we need to or we think we're going to need to. After COVID, there were people calling for Great Depression number 2, and we did the work the investment team, and we looked at the Spanish flu in 1918 and what happened to the stock market. And I think we were probably the first company, or we might have been one of the first companies in the country who talked about the Roaring '20s. And that was in May of last year, when, yes, it was a horrible health event. People are dying. It's happening again to some extent. But the stock market is a very unemotional beast, right? It wants to grow with the economy. These companies are not necessarily personable. They're trying to just grow their business for their shareholders and for their employees.
Going back to Jack Bogle, I know you did at Harvard. What was it you did there?
It was my thesis, my project. Yeah, was on Jack Bogle and Vanguard and just him founding it.
In retirement, you said something very important there, the risk versus reward trade-off. Okay, so Constellation Fund, great success, turned that around from about 11 or 12 billion up to 30 billion, and then you go to the Quaker for the Strategic Growth Fund, correct?
Correct, yeah. I worked for a company called DG Capital, based in Boston. I worked out here in Houston. Ran a mutual fund, a hedge fund, some pension funds, a little bit of everything. When I went there, I think we were just short of 300 million. And when I left 5.5 years later, we were at 3.1 billion, something like that, and had the number 2 track record over the 3 and 5 years that I was there. So you come up to DG Capital, help grow their fund from 300 million to a little over 3 billion in 5 years. Number 2 ranked fund by Lipper in your category over both 3 and 5 years. So when I look for investment managers and things to identify, one of the things you want to be able to see is the ability to replicate success. So from the small cap aggressive growth to the technology in Silicon Valley to the large cap at AIM, tilting the portfolios. Then after all that, you go and end up managing the number 2 ranked mutual fund over both 3 and 5 year periods. By the way, what happened to that fund when you left? It became number 1 for about 4 to 6 weeks in the summer of 2008. And went from about 3 billion to 300 million in the next year to 15 months, 2 years, something like that. It went from number 1 to off the charts on the other side.
So, and we're not going to get into, for the purposes of this video, kind of what happened there, but it wasn't, you weren't, let's say, it wasn't a fair deal.
The risk management tools went by the wayside.
Yeah. So, okay, with all of that you've done throughout your career, and here you are now, our viewers, our listeners want to know what is going on in the marketplace now. We've had how many consecutive months here? Now, recording this video, this is August 3rd. We'll probably release it around August, sometime in the next few weeks. But how many consecutive months has the market been up?
So 6 straight months.
So 6 straight months. So we see it all the time, prospective clients, whether you're calling in from YouTube, from the radio show, from locally. People are getting a bit nervous. We're seeing first you have all the noise from the television news stations. The articles were inundated with so much these days. Where are we at in this cycle, and what do we anticipate happening over the next several months? Should people be concerned, or are conditions ripe for continued growth in the market? Nothing's guaranteed, of course, but where are we at, and where do you see things going, let's say, over the next 6 months?
Right. So, yeah, we've had 6 straight up months. A lot is being made on TV about that. And the tone and the tilt on TV, when I listen to it, that's negative. I guess it's negative if you weren't in the market because you missed it. And I have to get hold of the exact statistics, but in looking at the data over time, it's happened a number of times in the past. So I'm like, well, that seems pretty positive, even though the last 6 months have been up. There's a lot being made of the year to date, or for a year ago, I think we're up 36% or 35% year over year. If you look at the data says when things are strong in the first half, they're usually pretty strong in the second. And so our outlook, has been let the good times roll. That doesn't mean it won't be bumpy. People are worried about volatility, and I worry about all these things. The only time I don't worry about them is when I'm gardening on the weekends and I'm digging in the dirt. But I worry about volatility. I worry about taxes. I worry about seasonality. I worry about all those things you hear about on TV. I try to worry about them in advance, not while they're hitting. So, we've done some studies on seasonality, and there's a lot of pieces out there right now talking about the average downturn during summer between August and October is somewhere between, it's over 5%. And people throw out, well, there's normally a down 10% to 14% at any time during a year. We look at this year, and we look at what the Federal Reserve is doing, and we look at what is going on fiscally in Washington, D.C., and I can't see it. I can't see anything that big to the downside in the second half of the year. It looks more and more every month, every week, as if we're just on the playbook that we've been on this cycle since 2009, 2008, when the Federal Reserve started QE programs. 2009 was a good year. The summers, we weren't down that much between August and October. 2013, first year of Obama's second term, I was deathly afraid of everything that year. Market barely went down during the summer. 2017 with Donald Trump, was probably one of the lowest volatility years we've ever had. So if you put together the 9 months during first presidential terms since Federal Reserve's been doing QE from August to October, this cycle, 2 have been down, 2 out of 9. And the biggest down month we had was like 3.2%, which if you're good enough to sell the top and buy the low for 3.2%, call me up. I'm giving you my money. Right? I mean, no one can do that. No one can do it.
Even if you can do it, again, we're getting into what's the point?
Yeah. I mean, and from a retirement standpoint, from an accumulation standpoint, the studies show it's time in the market, not timing the market. And we do some things tactically when we see seasonality or we see industry weakness or benefits from what the Federal Reserve is doing. But we don't run all the way to one side of the ship or get out of the boat entirely.
From a financial planning standpoint, what we do here at Oak Harvest Financial Group, we fundamentally believe that the planning is equally as important as the investments, and the taxes are just as important as all of those. How much does that, when you're managing money, just understanding that there is a plan in place and you're not just independently managing money for just growth, blind growth, right, whatever it is, actually knowing that you're managing money as part of a broader plan that is looking at people's individual needs, what their situation or circumstances are, and also with respect to the tax plans that we'll have in place. Does that financial planning at all kind of impact, or how does that make you feel when you're managing money and you know there's a plan in place as opposed to just blindly managing the money?
If it was my money, it'd make me feel a lot better. But it's other people's money, and I still worry about it, right? I mean, I take my job as seriously as I did when I managed $33 billion. Whether it's an account that we have that's, $500,000 or $5 million, I worry about it the same. The financial planning aspect, I love it because, for anyone who's in the market near retirement age or in retirement age, it's not about how fast you grow it, how big it gets when you die or you leave it. It should be about, do I need it? And how do I need it? Do I need it in income? When do I need it? How do I minimize taxes? How do I gift it? All those decisions that are so much more complex than I'm working, I'm getting a paycheck, I'm saving 10%, it's going in my 401k, I'm putting it in these index funds. That's the easy part, the accumulation phase. The retirement phase, there's so many more different decisions being made, and I'm glad you deal with that, not me.
And I always say the biggest value of a good advisor in retirement, it's not just about managing the money. The managing the money is absolutely critical, but it's really the relationship that leads to consistent and frequent discussions, helping with those decisions. And retirement, in the financial planning aspect, is very similar to investing in the sense that the goal is to compound returns over time. In financial planning and retirement planning, we're trying to compound good decisions over time. And the incremental value or the marginal value provided over time is, I think one of the things that some people either get it and some people don't. Some people are just like Troy, I'd rather just put it into an index fund at S&P 500 or with Vanguard, pay 0.02% and then make all those decisions myself and figure it all out myself, or it doesn't matter. And that's fine if that's who people are and you don't see value in the decisions and the conversations and whatnot. But that's one of the things for me, knowing that on the investment side, that portfolio is working in conjunction with the plan, not only for generating income, reducing taxes, but all of that's working together. And then the conversations that we have, every 6 months we typically do reviews with clients and we're having these conversations, but the compounding of those good decisions over time is very, very valuable. Okay, quick fire here, rapid fire. What time do you wake up in the morning?
4:30.
What do you do when you wake up?
Get up, walk the dogs, and work out for an hour and 15 minutes.
One of the things you always talk about is you don't really have an off switch. So when do you turn it off?
3:15 on Fridays through around noon on Sundays. Yeah, we manage retirees and pre-retirees' money. My brain is still in the hedge fund mode, the institutional mode, the worry mode. I mean, it's I can't control it all. And my job's not to, and we make mistakes, right? We're human. The stock market is, a humbling place to work and operate. But I still take my job as if we're managing $30 billion and it's some big pension fund, and I'm going to have a meeting, and my job's on the line.
What's the number one thing you consistently see that retail investors do that they shouldn't?
Probably time the market or think they can time the market. Chris, are you going to get me out? I'm like, no, I'm not going to get you out. We're going to tilt a portfolio if we see risk coming, or if we see, things kind of getting murky. But we're not going to get you out because it's time in the market, and you have assets that have been put there with your financial plan that are supposed to be looking at time periods 5 years, 10 years, not 5 weeks, 5 months. So trying to time the market's one. Probably having too much concentration, as a retiree, if you need the money, not if you're going to leave it for someone else, 20 years from now. But if you need the money, having too much concentration in the industry that you work or used to work because you knew that industry, that's a big one. The stock market doesn't care whether you worked at a company or not. And so getting emotionally attached to the industry and the stock that made you your livelihood, even though you're not working there anymore, that can be very dangerous. And I know it's hard because if I worked for a company for 35 years and my entire nest egg in retirement came from working there, it'd be hard to detach myself. But that's a big thing, is trying to remove that, hey, it was a great company, treated me great, I no longer work there. I have no idea what's going on there. I probably need to diversify.
Any last words for the listeners or viewers today in regards to the market, what they should be doing or should not be doing?
It's summer. So far, it's a normal summer. There's lots of volatility you see on the screen, but behind the scenes, a lot of that volatility looks very much priced into us, which is why we're not overly concerned about a big summer swoon, which people are talking about. We can't see that.
Chris, I want to thank you very much for your time today and everything that we went through to help provide insight to the viewers and listeners. So appreciate it. Thank you very much for all your time today. Make sure to hit the subscribe button. Make sure to hit that thumbs up, and feel free to comment down below. We'd love to hear your comments, and we want to thank you for tuning in today.